In the late 2000s, a new name began making waves in China's coffee market: Luckin Coffee. It wasn't just another coffee shop trying to compete with Starbucks. It was marketed as a revolution, a bold new startup that promised to change how people consumed coffee in the world's fastest-growing consumer economy. With sleek stores, heavy use of mobile apps, aggressive discounts, and a modern lifestyle image, Luckin captured the imagination of millions of young Chinese professionals. The brand grew at lightning speed and was celebrated as a symbol of China's ability to build a global competitor against Western giants. By 2019, Luckin Coffee had listed itself on the Nasdaq, becoming one of the biggest Chinese IPOs in the US at the time. Investors were excited, analysts praised its growth, and customers lined up daily for their discounted lattes. But beneath this glossy image, something was deeply wrong, something that would soon unravel into one of the biggest accounting scandals in recent memory. To understand the scandal, we need to go back to Luckin's origins. Founded in 2017 by Jenny Qian, a former executive at UCAR, and backed by Charles Liu, a well-known Chinese entrepreneur, Luckin's strategy was aggressive expansion. Within 2 years, they opened thousands of stores across China, surpassing Starbucks in terms of number of outlets. The company relied heavily on technology. Customers ordered through an app, paid digitally, and often picked up drinks from small kiosk-style stores with minimal overhead costs. This lean model, combined with deep discounts, created the image of unstoppable growth. By the time it went public in 2019, Luckin was claiming revenues in the hundreds of millions of dollars and was valued at nearly $12 billion. For investors looking for the next big thing from China, Luckin looked like a dream come true. But what nobody realized was that much of this success was being built on fabricated numbers. The heart of the scandal lay in Luckin's financial reports. To attract investors and keep stock prices soaring, the company needed to show skyrocketing sales and rapid adoption of its products. But real sales were not enough to meet the ambitious targets set by its executives. So according to later investigations, Luckin executives engaged in systematic fraud. Beginning around the second quarter of 2019, the company started inflating its revenues by creating fake transactions. Employees fabricated receipts, worked with fake customer accounts, and processed non-existent coffee purchases. In simple terms, Luckin was reporting sales that never happened. By the end of the year, the company had fabricated roughly $310 million worth of revenue, accounting for a significant portion of its reported income. This wasn't just a small accounting error, it was a massive scheme designed to mislead shareholders and pump up the company's stock price. The deception worked for a while. Luckin's stock surged after its IPO, gaining the confidence of international investors who were eager to get a slice of China's consumer boom. Headlines hailed it as the Starbucks killer and praised its innovative tech-driven model. In early 2020, it was trading at more than $50 per share, with a market capitalization of over $12 billion. Behind the scenes, however, whispers of irregularities began surfacing. Short sellers, investors who bet against companies, started digging into Luckin's business model. In January 2020, Muddy Waters Research, a well-known short-selling firm, published an anonymous 89-page report accusing Luckin of inflating its sales. The report was based on extensive evidence, including thousands of recorded store visits, customer receipts, and mobile app data. At first, Luckin strongly denied the accusations, calling the report false and misleading. But the truth was about to explode in public. In April 2020, just a few months after dismissing the allegations, Luckin dropped a bombshell. The company admitted that its chief operating officer and several employees had fabricated over $310 million in sales. This confession shook the financial world. Investors who had poured billions into the company saw their wealth evaporate almost overnight. The stock price collapsed by more than 80% in a matter of days. Nasdaq quickly moved to delist Luckin, citing the company's inability to provide reliable financial information. In the end, Luckin Coffee became a cautionary tale of how unchecked growth, blind investor optimism, and weak corporate governance could combine to create a disaster. The scandal was not just a financial embarrassment, it was a blow to investor confidence in Chinese companies listed on U.S. exchanges. Many investors, particularly in America, began questioning whether they could trust the financial statements of fast-growing Chinese firms. U.S. regulators, including the Securities and Exchange Commission, SEC, opened investigations into Luckin. The company eventually agreed to pay a $180 million fine to settle fraud charges with the SEC. At the same time, Chinese regulators also imposed penalties, and several executives, including the COO, were fired. Luckin's founder, Charles Liu, faced immense pressure and eventually stepped down from his role. The company went through a painful restructuring, closing many stores and cutting costs as it tried to rebuild what little credibility it had left. The human impact of the scandal was devastating. Thousands of ordinary investors lost money, including retail investors in both China and the US. Employees who had proudly worked for a national champion suddenly found themselves working at a company branded as a fraud. Customers who had been loyal to the brand began questioning its future. The scandal also fueled geopolitical tensions, with U.S. lawmakers using Luckin as an example of why stricter auditing requirements were needed for Chinese firms listed on American exchanges. In many ways, Luckin became more than just a corporate scandal. It became a symbol of the fragile trust between international markets. Yet what makes the Luckin story even more surprising is what happened afterward. Unlike many companies destroyed by fraud, Luckin Coffee didn't completely disappear. After restructuring and replacing much of its leadership, the company continued to operate in China. In fact, it managed to survive and even grow again, focusing more on real operations instead of inflated numbers. By 2021 and beyond, Luckin slowly regained popularity among Chinese customers, largely because its coffee was still affordable and widely available. In an ironic twist, the very company that committed one of the largest accounting frauds in modern history is still serving millions of cups of coffee today. But its reputation will forever be tied to the scandal of 2020. The Luckin Coffee scandal reminds us of a powerful lesson. In the world of high finance, numbers can be manipulated, stories can be exaggerated, and investors can be blinded by dreams of fast profits. But eventually, the truth catches up. For every booming stock price and glowing media headline, there must be real business performance behind it. Luckin's executives thought they could cheat their way to becoming a global powerhouse, but in the end, they not only destroyed billions of dollars in shareholder value, but also stained the image of Chinese entrepreneurship on the world stage. It is a story of greed, ambition, and deception, a modern parable about the dangers of chasing success at any cost. And perhaps the biggest irony of all is that Luckin Coffee's product itself, simple, affordable cups of coffee, was never the problem. Customers liked it, the stores were convenient, and the business model had potential. If only the company had grown more slowly and honestly, it might have built long-term trust and value. Instead, by fabricating sales and misleading the world, Luckin showed that no matter how exciting the story, fraud eventually destroys everything it touches. For investors and entrepreneurs alike, the scandal stands as a reminder. Numbers can lie, but the truth never disappears forever.